if you're not investing in multifamily right now and you're making the excuse that I'm going to wait until rates drop, when interest rates are low, there's a lot of euphoria. There's a lot of happiness in the market. We've taught our members to raise almost $1 billion in capital for their deals. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, we're going to be discussing the new rules of raising capital. Did you hear I put a little nuance on the new rules? They've been the rules all along, but from my point of view, rules change throughout market cycles. So these rules that I'm adhering to now, a couple of years ago, you didn't have to worry about it because it was so much easier to raise capital in 2020, 2021, 2022. Now, why was it easier to raise capital? Let's do a little bit of history before we jump into these new rules, because it's really important to understand what's shifted, how it's shifted, and how I'm going to be discussing today what rules you can use. And you may be saying to yourself, well, why would I listen to Gino? He doesn't syndicate anymore. And that's a fair point. But I did syndicate. And in the Wheelbarrow Profits community, we've taught our members to raise almost $1 billion in capital for their deals. We've syndicated 3 deals successfully. I've raised over $10 million, and we've taught the community to raise around $1 billion. Now, that's a lot of money. And things have shifted. So if we go back to 2020 and 2021, what was prevalent? There weren't very many deals, but the cost of capital and interest rates were really low. Everyone was chasing deals. There was a proliferation of money. When interest rates are low, there's a lot of euphoria. There's a lot of happiness in the market. There's a lot of frothiness in the market. So it's not very challenging to raise the capital. The capital is there and it's looking for a place. Now, you had a few things that were going on at that period. First of all, the family offices were starting to look for alternative investments. Number 2, you had private equity that when they have this cheap capital, they need a place to be able to find it. And number 3, when rates are low and they're, let's say, 3%, and you're buying a deal that has a 4 cap, you have positive leverage because cap rates are 3 and it deals at 4. That same 4 cap deal today cannot be accomplished, or you're not even looking at it if rates are 7, unless you can move that 4 cap to a 9 cap, then you're creating positive. If that's not the case, that's why back in 2021 and 2022, when things were just humming along, it was real easy. There was a ton of money. Multifamily had been going up. The market cycle was getting to the point where every 18 months, a deal was being bought and flipped. And LPs did not care. They didn't read PPMs. They were just like, here's my money. I've got $50,000. Classic example. An investor started investing in 2015 and 16 with that $50,000. All of a sudden, that $50,000 in 2016 traded. In 2018, that LP got back his $50,000 plus more money. He kept it with the sponsor or the syndicator, put it into a deal. 2018 becomes 2020. That deal doubled again in 2020, flipped it into the next deal. All of a sudden, you're in 2022, and it's easy because you've built up your list and you've got a lot of deal flow. But, now we've gotten to 2024, 2025. Things are more challenging. Interest rates, which everyone thought would go down. Everyone said survive to 2025. Well, we're in the middle of 2025, and there's a lot of people who aren't going to survive this. That's the reality. So what do you need to do to start shifting to be able to say deals are coming? Because I'm going to tell you right now, if you're not investing in multifamily right now and you're making the excuse that I'm going to wait until rates drop, I'm going to wait until the market crashes. Well, the market hit a high in 2022. We're down 20%. And in certain markets, big markets like Dallas, big markets like parts of Tennessee that I know, Florida, these assets are down even more, and they're going to continue to drop. because buyers are saying to themselves, I am not overpaying. And why is that? Well, one reason is they need to come up with more money for a down payment. LTVs are shrinking. What we used to be 75 and 80%, now banks, credit unions, Fannie, Freddie, they want 65% LTV. They don't want to take all the risk. And then you have NOIs that are dropping, rents that are staying flat. So prices have to drop unless you're in a quality institutional A asset. But even those are doing phenomenal for the buyers because these builders built these assets. All of a sudden, they're into these assets. I just saw an asset in Huntsville, Alabama, 2023 build, either 23 or 24. It's trading for $192,000 per unit. They dropped the price $4 million. It's 87% occupied. Builders are great at building. They don't know how to manage. They don't want to be in the business of management. Now, when the cycle was going up, they didn't have to be. Now, that asset guaranteed is trading below replacement. I remember Huntsville a couple of years ago, you couldn't buy a C asset built in the 60s for $192,000 a door. And now, right now, you're buying new assets. So just be very careful of what's going on inside the market cycle. The first one is if you don't have credibility with raising capital, find somebody who does. Find a sponsor, join their team. Now, you can't join a team and say, hey, I'm here just to raise capital. I want to be part of this team. You need to be part of the team in other instances because you cannot be compensated just for raising capital unless you have a broker-dealer's license, right? You're a security, a syndication is a security. If you don't have a securities license, you can't be compensated just for raising capital. So if you're going to, what they say in the business, co-GP or become part of a sponsorship team, you better have other qualifications to join that team, whether it's asset management, whether it's property management, investor relations, you need to be part of that team. But that's a great way to get into the business. If you haven't done any deals or you're in the midst and you're just starting out, this is your first syndication, I would also say, if you've done deals like Jake and myself, when we started out, we were not syndicating deals. We were buying deals by ourselves. We were creating credibility that way. Then when our first syndication came, it was a $6 million deal. We needed to raise $2.2 million. It was a lot easier to raise because we had the business plan. We had executed on several deals. We had gone full cycle on several deals from the refi and roll route where we refinanced the deal. We didn't sell the deals, but the investors could see, wow, Jake and Gino created a ton of value on all of these prior deals. Now they've got credibility. So if you don't have credibility, number one, go out and find somebody who does. Understand, this should be the second one now. Find the credibility if you don't have it. And if you do have it, start with a smaller deal. The second one, the new rules of raising capital. In 2020 and 2021, people didn't really care. And I'm sorry to say it, but LPs weren't really looking at your business plan. They had extra money. They saw a deal or what they thought was a deal. They put money into a deal. And one of my favorite sayings, I don't know who said this, but a person with money, the LP, meets a person with experience, the GP. The person with the experience, the GP, gets the money, and the person with the money, the LP, gets the experience. How do I know? It's happened to me in a previous market cycle back in the early 2000s. I was just so gung-ho on throwing money into a deal, and I was like, I need a deal. Where can I find a deal? And I found a GP. We partnered up. He was, how shall I put it? Incompetent, negligent, maybe fraudulent. I mean, a nice way of saying he was a moron. He didn't know what he was doing. That made me a double moron because I didn't know what I was doing. Put the money with him. 18 months later, the money was gone. So this is the second rule for me. Understand the sponsor's business plan. Now, in Wheelbarrow Profits, we've created buy right, manage right, finance right. If you want to learn more, go to wheelbarrowprofits.com to learn more about the strategy. If you want the book, Wheelbarrow Profits, just email me, gino@jakeandgino.com, and I'll send you a PDF copy. You need to understand a framework. You need to understand that real estate multifamily is a business. Do you have a map? Do you have a process? I have life before Jake. I didn't have that map or process. I was investing in deals, but didn't understand what the business was all about. You need to learn how to buy a deal, how to finance the deal, and I think more importantly, how to manage the deal. So if you're going to raise capital, you need to have a strong team built around those three pillars. Back in 2020 and 2021, you didn't have to be a strong manager. Because if you go back into history, remember what was happening? Everyone needed a place to rent. Rents were going sky high. You did need to manage. And of course, you did need to manage because in 18 months, you're flipping out of that deal. So the manage right was not important. Now it's back to fundamentals. It's blocking and tackling, as they say in football. Or in our business, it's operations and managing right. Understand that when you're raising capital and you're going into a deal, you need to have a strong team, an asset management team and a property management team. And more importantly, you need to have a process. Your sponsorship team or the person you're sponsoring with needs to understand those three pillars. Even if they're not using it subconsciously, that's the framework for multifamily. Buying this deal at a certain price point, understanding your criteria, financing it with the proper financing, understanding the exit strategy, and then obviously that third component, how are you managing this asset from a property management perspective, customer service, customer journeys, and asset management, budgets, CapEx projects, returning capital to investors. Those you need to understand clearly because 3 or 4 years ago, that was not the onus. That's not where people focused. Now, if you want to raise capital and make money in this business, that's where the impetus needs to be. Now, there's a couple other things that you need to do to become successful and to really create, I would say, raving fans with investors. The next one is you need to have more touch points. And we were pretty successful with this when we did our syndications. Our very first one, we were doing monthly webinars because we were so excited. We wanted to keep our investors engaged. We wanted to keep them on the hook. We created newsletters, sending newsletters out quarterly. We even during Zoom opened up a weekly call on Fridays. People were freaking out. I remember when COVID happened, March, April, the big worry was, are people going to be paying rent? We actually started out a daily collection of rent on our syndications and showing the investors and tracking collections of rent. And it was really cool. And we created loyalty. We got on every Friday. A lot of investors, most investors didn't get on. But the ones that did, they were the ones that were more locked in. They were the ones that had more questions and were able to answer all of their questions. Don't bury your head in the sand. You need to have transmissions. You need to be able to reach out. And there's so many different portals right now, whether it's Capitalist Pro, whether it's Cash Flow Portal, Syndication Pro, whatever it is, there are so many CRMs out there that make it easier nowadays. But don't only focus on those automations. Pick up the phone. Text your investors, create a relationship with them. So when something does happen, you're ahead of it. And more importantly, when you do get a deal, it's not the first or second touch point by you reaching out and saying, hey, Gino, I've just got this opportunity. I don't want to hear from you if you haven't talked to me in 2 years and then you have an opportunity. Well, obviously, I'll still want to listen to it. But if you're continuing that conversation with me and you're hitting me up and texting me and you saw me at a seminar or you did a webinar with me or we went to a live event together and we saw each other, that's what you need to be doing with your investors, having touch points. This next one is also really important. Longer hold periods. I had alluded to that a few minutes ago. But right now, it's not the 1 to 3 year time period. I'm sorry. You're looking, to me, a minimum of 3 years, probably 5 to 7 years. If you're telling your investors 1 to 3 years, unless you've got a development deal or something that you think you can push that quick, great. What's going to happen is investors after 24 months are going to get a little itchy and saying to themselves, when am I getting my money back? You told me I'm getting it back between 1 and 3 years. Be realistic with them. And if they don't have that time horizon, well, then they are not what Ian Altman says in finding impact together, that fit. That's his acronym. You need to find impact together with your investor, not work on different sides of the table, work on the same side of the table. If the investor can't hold his money in that property or her money in that property for a time allotted that you need, a 5 to 7 year time hold, it's probably not a good fit. So making investors understand that. And I think the last one, now this is from Kim Taylor. We did a weekly masterclass with Kim Taylor inside Wheelbarrow Profits. She was on a couple of weeks ago, and she was discussing what she's seeing. She's helped investors create billions of dollars of PPMs. She's helped them with all of their docs over the last 15 plus years, probably 3 decades. And what she's seen in this part of the market cycle, all the IRRs are down for every single asset class. We'll take a stroll down history lane again. Back in 2020 and 2021, IRRs, 18 to 20%. That's what people were talking about. Now, 13 to 16% for multifamily. Each asset class is a little different, but I would say to yourself, if you're telling your investors 18 to 20, it may hit that, but typically what most people are seeing right now are 13 to 16%. And I think investors would be happy with that. And why is that? Because back in 2020 and 2021, a lot of investors were buying riskier assets, older assets, buying much more in the value add space. What we're seeing right now is a lot of sponsors, Jake and myself included, were willing to buy newer assets. Now, for Jake and myself, we don't have the 3 to 5 year time window. We just closed on an asset 2 months ago. It was a 2024 build. Are we looking at this asset and saying, we're going to hit a 20 IRR and we're going to be out in 3 years? No, this is a long-term hold for us. We're going to be holding this asset. We're going to be raising rents slowly. We're going to be able to hold it because it's a new asset. So in 10 years from now, it's still going to be new. So we're willing to take a little bit less on the IRR and the return in the short run. And there's going to be less risk because there's a lot less CapEx, a lot less work to do with this property. So the IRR may seem like less on the front end, but we know it's a much more stable asset and we're limiting our downside risk. So if you're seeing these assets that are showing 20, 25% IRR, just take a pause. Make sure you read what's going on. Make sure that rents can go up that much. Make sure that their expenses are actually expenses in the market and that they're not going up by just, let's say, 1%. They need to have conservative underwriting. Just be aware of what the asset where you're buying it in the market cycle right now is a flight to quality. And what happens when the market pulls back, prices start to drop. There's a lot more fear in the market. You hear it in the stock market, flight to quality. To me, it's the same thing in the real estate space. People are flighting to quality. They're flying to quality, not only with the asset themselves, but the market where you buying these assets. We like these growth markets in the Southeast where people are moving to. The quality of the asset, the location, the median income of the asset. These are a lot of things that I just talked about a few minutes ago with the buy right, understanding the buy right and understanding the general partner's plan with what they're trying to accomplish. I think ultimately, when you're raising capital in this part of the market cycle, being open, being transparent, showing your credibility, being able to answer all the questions in this deal. And if you don't know the answer, don't lie. Just go back to the investor and say, that's a good question. Let me find that out for you. But you should be prepared on the front end. If you don't have the credibility, once again, go out and find somebody who does and partner with that person. Now, I'd love to hear what you're doing right now in this part of the market cycle to be able to raise capital. Down below, there's a comment section. Please leave me a comment. Say, hey, Gino, this is what I'm doing. This is what's working for us. And if you like the video, hit that like button. Subscribe to the Jake and Gino YouTube channel. And before we sign off, once again, Gino at jakeandgino.com. I'd love to give you a free copy of our Wheelbarrow Profits book. And until next time, go out there, raise money for your deals. Don't be afraid. Continue to invest in your investors. Learn the 3-step process: buy right, manage right, finance right. And I'll see you on next week's How To. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.